And I want to introduce our special guest for today, and that's Mike Fenison. He's a certified financial planner, CEO, and founder of Pure Financial Advisors. Mike, welcome aboard today.
Glad to be here, Al.
So I want to ask you the key question on everybody's mind right now. Given the market conditions, given the stock market is at or near all-time highs, everyone's saying there's a bond bubble. So should people still invest in bonds?
Well, for most people, the answer is yes. It's understanding what the role of bonds is in a total return portfolio. And the main advantage of bonds is that it gives you a relatively predictable way of controlling the risk in the portfolio.
Okay, so we need it because if we don't have any bonds, like let's say we go 100% stocks, for example, then we're at the mercy of the market. Market goes up 20%, that's great, but market could go down 50% as it did, say, in 2008.
Right, and we can't really predict the direction or magnitude of stock market changes, but if you add a bond component to that, you can mitigate that volatility, and you can control it so that it matches with the cash flow requirements of a client or matches up with their financial planning so that they know that they can weather a storm either in interest rates or in stock market movement.
Well, that's a good point, because liquidity, I mean, that's when you're in retirement, for example, and you need assets to live off of. If you have all your assets in the stock market and the stock market has taken a dive, and you're pulling money from the accounts at the same time, it's hard to recover. If you've got some bonds that are more stable, you can pull assets out of your bonds at those times.
Right, and you have to look at the overall portfolio. So, for example, if you needed cash in 10 years and you had a 10-year bond, even if interest rates were to spike and the current value of that bond were to drop, that value would be restored by the maturity date of the bond. So you really wouldn't get any less of an expected return than when you originally purchased the bond.
All right, so given this economic climate with interest rates pretty low, and at some point, we don't know when, but at some point they'll likely go up, what kind of bonds should people be looking at?
Well, it depends on their tax bracket. So if they're in a very high income tax bracket, they might be looking at municipal bonds. But in general, you want to be looking at shorter term, higher quality bonds. You'll avoid some of the credit risk with high quality bonds, and the shorter the duration or maturity of the bond, the less interest rate sensitive it's going to be.
Yeah, because bond prices actually go up and go down based upon interest rate changes. And there's an inverse relationship, right? As interest rates go up, bond prices actually go down. And
there will be a sea change. For the last 30 years, interest rates have been in a relative downtrend, which means when you look at the total return of a bond that's liquidated before maturity, you're not only getting the coupon rate, but you're also getting a capital gain because you may be selling it at a premium. When interest rates start going back up, then if you sell a bond midstream, you're going to get the coupon rate probably taking a discount if you want to liquidate it. So it's really important to tie those maturity dates and duration of the bond to what your cash flow requirements are so that you're not forced to liquidate those bonds before you need the money.
Now, and I agree with you, short-term bonds, high quality, are probably the way to go, but there's not much yield in them. So should that concern us?
Well, certainly everybody wants higher yield. Everybody wants more, and they don't want to take any risk. But risk and return are related, and it doesn't matter what type of an investment that you're looking at, there's a direct correlation between risk and return. So if the bond rates are not high enough for the appropriate bonds to your portfolio and you start searching for higher yield somewhere else, there's going to be a corresponding risk associated with that investment that may not show up. You may not be aware of it until it's too late.
Yeah, and I would say what's interesting about bonds is when you take more risk, when you go longer term, or when you have lesser credit quality, yeah, you get a little bit higher yield, but that yield is not that great, not that much greater compared to much safer bonds. And you do get compensated more in the stock market. So if you're going to take risk, you might as well take it in the stock market side.
Yeah, if you want more risk, you take it in stocks, not in bonds. And when you're looking at how long you want to go out on the bond, you're looking at at what rate of return you're going to get, and is it tied to your financial planning? But the yield curve is what you're looking at, and the yield curve doesn't necessarily change the same for all bonds when there's an interest rate spike. So there might be something to happen in the interest rates, and short-term bonds may be affected and longer-term bonds may not, or the opposite may happen. So not all bonds are going to react the same to the same stimulus in the economy.
So now we're getting complicated, yield curve and so forth. But the key is, yes, most investors probably still want bonds, probably want to stay short-term and high quality in this bonds in this environment. So where can people go for more information, Mike?
Well, for more information, I mean, bonds are a complex topic. And if somebody's concerned that interest rates may adversely affect their portfolio, we offer a free portfolio review and assessment at Pure, and we'll take a look at their entire portfolio and the role that bonds are playing within that portfolio so that they can understand the risks and the potential.
Right. Well, thanks, Mike, for joining us.